Good morning, ladies and gentlemen. Welcome back to the Finance Magnates Africa Summit Day 2. You're here with me, Jatasini, at the Traders Arena today. Get ready for the most educational and engaging sessions here, from finding the right trading strategies and performance evaluations. Get more advanced on charting and futures trading, and more top-notch workshops from Investing Lives Academy. Let's begin our day 2 with a practical workshop on choosing a trading approach that matches your capital, schedules, and temperament. Please welcome Angela Gruzdova, Head of Customer Care at Headway, in this session, Finding a Trading Strategy That Fits You. Get ready and please give Angela a warm welcome.
Hello, everyone. My name is Angie. I am the head of customer care support with Headway. We are booth number 12, by the way. Please visit us. So today I would like to speak to you about some components of trading, what to think about and consider when trading and choosing the trading strategy that fits you. The first thing that I want to mention is that may be kind of obvious, but we are people and we are different. And so traders are different, and likewise there are a lot of different trading strategies. A strategy that suits one person is not guaranteed to bring profit to somebody else. So let me just tell you a little bit about a few common styles or types of traders. So there are scalpers, and scalpers are traders that like to work on lower time frames, and they open a lot of little small trades, and as soon as they make a little profit, they close the trade. So it's kind of like pariahs in the market, grabbing little chunks of the market. And the thing about this type of trading is, in my opinion, this is more of a stressful approach, in my opinion. You have to be very attentive, and you have to spend a lot of time looking at the screen. You also have to make very quick decisions to open and close the trades at the correct time in order to make a profit. The next type of traders is day traders. And so day traders, they open and close their trades within the same day, meaning that they do not keep their trades open overnight. And in a way, this is good because they will not be, for example, charged swap fees for keeping the orders open overnight. Additionally, their orders will not be exposed to unexpected price swings around the market close and market opening times. On the other hand, there is no guarantee that you will find good opportunities every single day, or that the entry points that you do decide to take will be profitable. So day trading will take up a lot of your time every day, and I think that we can say and we can consider this a full-time job. Now then, we also have, for example, swing trading. And swing trading, this means that a trader keeps their orders open for several days and sometimes actually even longer. If you have analyzed the charts or looked at the price charts, you can see that the price of different instruments is always swinging, and it's always moving in different directions. So there are also certain levels on the price chart from which the price seems to bounce, or sometimes it even breaks through these levels. And these levels are called our favorite support and resistance levels. So when the price gets too low, it's met by the support level. And if the price gets too high, it's met by the resistance level. And the point of swing trading is to capture these market swings for profit. The good thing about swing trading is that you have more free time. If you find a good opportunity, you open an order, and then you give it time, you wait, checking back from time to time to see how the trade is going. The flip side of this is that you have to wait. You have to be patient for that good opportunity and for that entry point. That's not as easy as it may sound. Discipline and patience is actually very important for everyone, not just traders, but especially traders for sure. Now, as I mentioned, the price is always moving, and there are a few things that can be happening to the price. The price can be going in an uptrend, the price can be moving in a downtrend, or the market can also be moving sideways, which is also sometimes referred to as a flat. And in most cases, whether the price is trending or moving sideways, the price is likely moving alongside of these support and resistance levels. The point that I'm trying to make, that I would like to make here, brings me to risk management and the use of stop loss and take profit orders. You guys would be really surprised at how many people don't use these fantastic tools that are available for everyone. When you open an order, you should set a stop loss. And in the event that the price starts moving in the opposite direction of your trade, the order will automatically close and it will minimize your losses. And likewise, you can set the take profit order. And when the price reaches a certain level, the price on the chart, the order is going to close, so you don't miss out on the opportunities. So please remember to use stop loss orders. That's honestly one of the best pieces of advice that I have. Now, another important risk management factor to consider is the amount that you are trading with and the number of orders that you are opening. What I mean is, consider the amount that you have on your trading account. As a general rule, it's advised not to risk more than 1 to 2% of your trading account for a single trade. So don't go all in and open so many orders that you don't have any margin to maintain your open positions and give them a chance to work, to move, and to make a profit. Another very important thing to note is losses are a part of trading. This is just something that we have to accept, and from time to time, we will encounter losses. You just need to set a goal for your risk to reward management of like 1 to 2, or even better, 1 to 3. Like a very easy and common example is, like, for example, if you buy an asset that costs $100, you set your stop loss if the price reaches $95, for example, so you are risking $5. And if you set your take profit, so you plan to close the trade when the price of the asset reaches $115. This is an example of a 1 to 3 risk to reward ratio. You should also consider how much losses you are willing to accept for the day before you stop trading. If you are experiencing continuous losses, you really should stop. You should take a pause, take a break, relax, and then try to analyze what happened. The thing is, again, we are human, and it is important not to fall into emotional trading, aka revenge trading, aka trading to make back our losses. Such actions will usually lead to more mistakes and potentially more losses. So how are we going to find a strategy that fits you? I'm going to tell you about the 5-3-1 approach. 5. Focus on selective instruments. Ideally, you want to pick currency pairs built around maybe 2 or 3 major currencies that you understand best. For example, with USD or with Euro or GBP or JPY, some major currencies. Some traders, of course, especially lately, they like to trade gold or Bitcoin, depending on your trading style. See, when you limit the number of instruments that you are trading with, you start to feel the market and how the instruments move and how they react to news and so forth. So this is going to give us less noise, more clarity, and better decisions. Remember, Headway has over 500 different instruments for you to choose from. 3, limit to 3 strategies. This includes both your trading style and indicators, and you can break it down like this. Number 1, trading style. Pick what suits you best. Is it scalping? Do you like to, be that active, sit there in front of bam, 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 opening, closing all the time? Do you maybe like news trading, or maybe you like swing trading? Think and decide, how much time are you planning to dedicate to trading? How much time do you have? Are you like a really focused person that likes action and fast trading, or you're more of a calm person that would like to rather spend some more time analyzing the market, thinking and choosing a specific time and trade to take? Number 2, indicators. There are a lot of different indicators to choose from. There are, for example, moving averages that help us identify these support and resistance levels. There are oscillators like RSI or MACD that help us identify overbought and oversold areas where at which points the price is likely to reverse and start moving in the opposite direction. And then, of course, there are a lot of more complex indicators such as the Ichimoku cloud, which is actually maybe a little bit scary to look at if you when you first apply it to your chart. But actually, the Ichimoku cloud is basically a combination of indicators all in one. So the idea is to choose indicators that you like to work with, and when you have the same signal on 2 or more indicators, that is a potential entry point to enter a trade. And 3, risk management. Define it clearly. Risk management is extremely important, of course. Remember to set your stop loss. Remember your risk to reward ratio. There's actually another suggestion regarding risk management, and it goes like this. So I mentioned previously that you need to consider account balance and margins. So you may consider the 3-5-1 approach. So today is all about numbers. I'm sorry, my friends. So 3% for a trade, per trade. You'd never risk more than a small portion of your capital on a single position. This ensures that even a losing streak won't wipe you out. One bad trade remains just that, a bad trade, not a disaster. 5% per idea. So if you are opening multiple positions in the same direction, or for example, adding to a trade or trading correlated instruments. Correlated instruments are basically instruments that tend to move in the same direction. Your total exposure should not exceed 5%. This prevents you from unknowingly doubling down on the same risk. And 7% of total portfolio risk. Across all open trades, your combined risk should stay below this level of 7%. So even if everything goes wrong at once, your account remains intact and recoverable. Even if all trades hit stop loss at the same time, you only lose 7% of your account and not everything. This rule ensures that no single trade hurts too much, that no idea dominates your portfolio, and no bad day destroys your capital. So essentially, the rule is not about making money quickly, but staying in the game long enough to earn a profit. And number 1, trade at the same time each day. So yes, Forex, for example, is available to trade 24/7, but not all hours are equal and suit you. Liquidity changes, and so do opportunities. So pick your time and try to stick to it. And it should, of course, match your selected instruments and the strategy. So if you're trading USD, something with USD, they will be more active when the United States is awake. If you are trading currencies with NZD or AUD, they will be more active when New Zealand and Australia are awake. So you have to do your homework. You are here to make money. You need to learn. You need to check out different things every day. You don't just want to jump into trading blindly. You should check the economic calendar. Check if there are any news releases that will affect your trading. Are there any speeches scheduled for the day? So you see, there are 2 types of analysis. There is, and you should actually pay attention to both of them. There is technical analysis, and this is an observation of the price chart and the use of different indicators. And by the way, I want to mention that higher time frames, they are more dependable and provide us with a better idea of the dynamics of the price movement, versus lower time frames, which have a lot of rapid movement, which is also sometimes called market noise. And then there is fundamental analysis. This is macroeconomic news, such as scheduled economic releases. You know, everybody knows non-farm payrolls, NFP, right? And this can also be like scheduled or even sometimes unscheduled speeches and events that also have a huge impact on the price movement of different instruments. So I want to mention that Headway has an awesome copy trade ecosystem where you can observe different traders and their strategies, and if you would like to, you can copy their trades. Also, I want to mention that Headway has an awesome copy trade, partnership IB program. You can find different Headway IBs on social media and join their network, and a lot of IBs provide training and guidance. So let's round it up. Choose your assets that you want to trade with, and you have to learn about them, understand them. Pick your trading style. Remember, are you guys scalpers? Are you guys day traders, swing traders? There's actually even position traders, and this is more like investing. They open a trade and they hold it for a really long time. So they really want to try to catch, like for example, reverses of big trend movements. Um, Choose your indicators. There's a whole bunch of different ones that you can trade with. Test them out. You can test them out on demo accounts, the ones that you really like that are giving you results. Clearly define your risk management and aim to trade at the same time every day. My friends, I hope that my explanation and my recommendations will help you develop the perfect strategy that fits you. I do want to mention that Headway, especially for this Expo, Headway is going to have a free training course that starts on June 1st. If you would like to get some more information and how to sign up, we are on booth number 12, Headway. We'll be happy to meet with you, speak to you, answer any of your questions that you may have. Thank you so much for your time. I hope you enjoyed this day. Thank you for coming.